we're going to talk about the three biggest mistakes real estate investors make when they're buying real estate or even selling, but mostly buying real estate in Florida.
Welcome to the Jennifer J. Hammond Podcast. Jennifer is a licensed realtor, educator, speaker, and best-selling author. Jennifer's goal is to help you find your yay in every day.
Hello, it's Jennifer J. Hammond, and I'm so excited. We have Rich Ficca here, and we're going to talk about Florida Coastal Insurance Agency. That's his agency. He's been doing this for quite a long time. So first of all, welcome to the show, Rich.
Hey, Jennifer, thank you so much for having me. Excited to be here.
I'm so happy to have you because we're going to talk about the three biggest mistakes real estate investors make when they're buying real estate or even selling, but mostly buying real estate in Florida. So many people, we've talked about this before, are moving to Florida from all over the country, from California, from Texas, from New York City, from Kansas, and they really don't understand about insurance. So let's talk about the three biggest mistakes real estate investors are making as they come down.
That sounds great. So I will share with you that I am actually starting to dabble in the real estate pool myself, along with all these other folks. And so I can empathize with the challenges that happen as real estate investors. I will start with one that is the use of the real estate, right? So if I'm a real estate investor and I'm buying it to flip it or I'm buying it to hold it, obviously that's a huge conversation that they're having with themselves or whoever their investment folks are, or you as their coach, right? And the one thing I'll tell you is that if we drill down, if you're gonna keep it, if you're buying to flip it, it's pretty self-explanatory. But if you're buying to keep it, the usage is a big deal. And one of the big mistakes they make is because real estate investing, when we're holding it, is about margin, right? It's all about how much we keep at the end of the day, is knowing how much money you can spend on insurance if you plan to Airbnb it. So a lot of people, right? It's the super sexy way to do it right now. I'm going to Airbnb it and make a ton of money. And I'm sure you and other experts can talk to all the other challenges of Airbnb or VRBO or all those things. It sounds great on paper when you hear the success stories. I'm kind of peeking behind that, kind of hopeful. But I will say this to you. Florida right now is in the worst insurance marketplace I've been doing it 26 years. I've been selling homeowners and rental property insurance in Florida. This is truly the worst market we've ever had. So much so that people are very nervous about where it is. And so I'm sure your listeners have kind of picked up on that around the country. But because of that, our options are much more limited today than they were even 2 years ago, 18 months ago. And so if I'm an investor and I buy and I say, I'm going to Airbnb, the amount of options I have to actually get an Airbnb insured are extremely limited. I will share with you, I just had a client this week there. And by the way, we expect, this is a dirty little secret your investors may not know. So I'm going to share something with them they might want to know. Insurance in Florida 2 years ago, if you had a building worth $400,000, don't worry about the value of the dirt. We expected insurance to be 0.5 to 1.5%. Depending on a ton of other features. Where's it at? What's it made out of, et cetera. So if you came to me and said, Rich, I'm buying this $400,000 building. What's it going to cost to insure it? I'd say, Jen, it's going to be $2,000 to $6,000. Now, that's a huge spread, but right, there's some rough numbers for you. All other stuff aside, count on $2,000 to $6,000. That number's moved all the way to 1% to 2% here in Florida. So now when you tell me you have a $400,000 building, hey, Jen, I'm probably guessing $4,000 to $8,000 a year. Then you tell me you want to Airbnb it, we could be at 2% to 4%.
Oof, ouch.
Now there's a couple companies that will keep it in that range, but if for whatever reason it doesn't qualify for just the pool is so much smaller today that the minute we have to jump to special companies, we've seen when I just had one and the home had some challenges, and we don't need to get into why, but when their current insurance non-renewed them at $4,500 a year, their new renewal was $14,000.
Ouch. Wow.
So from a margin standpoint, if I'm a real estate investor and I give up $1,000 a month of margin, that's hurting. Now, some homes are worth it. If you've got a coastal home and you're making $300,000 a year of rev off of it, then you're not upset about paying an extra 10 grand, right? That's a cost of goods sold, but you just need to be aware what you're getting into. So the first thing I would tell your listeners is make sure if your usage is going to be something unique, like an Airbnb or a daily rental, make sure you factored that into your equation when you're deciding how much you can afford to pay for it. That'd be the first one I'd go over.
So one of the things that I would be curious about, if we can dig a little bit into that, is that, as you know, in Pinellas County, it's so interesting, the different areas, Clearwater, Dunedin, Tampa, they have different, I want to say, definitions of short-term rentals. So some of them, it can be daily. And then there's some of them that it has to be a week. Some of them it has to be monthly. The minimum, meaning the minimum amount of time is monthly. And then there are others where the minimum amount is 6 months. And that's still considered, again, the definition of a short term. I'm curious if that changes the insurance.
It does. I'll speak strictly through my optic for you. We typically look at a lease of 7 months or more as a long-term lease. So if your client's signing a 7-month, if your client is having their client sign a 7-month lease or more, typically that's going to be a long-term lease and is much easier. Then, okay, so think of it like that Auto Trader commercial where there were thousands of cars going over, and then they say, I want a red car, and there's less cars, and I want a red truck, and there's even less cars, and I want a red truck with 4 doors, and then 1 car slides in, right? So what I want your listeners to take from this is, I want to buy a rental, thousands of options, even in insurance. I want a short-term rental. Well, I want a 7-month rental, still more options to get insurance. I want a 30-day rental, less options. I want a 7-day rental, even less options. I want a daily rental. You're going to have even less options. And what does that less options mean? It means there's going to be less price competition. You could get lucky, and the 1 or 2 companies that want you are some of the best priced. Just doesn't normally work that way. So again, I would share with your listeners, the shorter the amount of rental time, the more important. So if they want to do a true Airbnb where they're renting it on a nightly basis, they're going to want to make sure they've priced that insurance to make sure before they buy it that it fits the equation for them.
Okay, and now I want to take us down the dark, as you talk about the dirty little secrets. Let's go down the dark tunnel, because I've had this where I'm like, as a real estate agent, you sit there kind of frozen. As a coach for my real estate investors, I sit there and go, no, 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 don't do it. I want to pull out that first grade kind of finger of no, no, no. I said no. So what happens? Let's take it there. When someone says, oh, I'm going to only rent this long-term, and then they rent it short-term, and then there's a problem and they want to make a claim.
All right. So it's a great question. It's a great question and matters in the real world, right? And there's 2 points I'm going to make to you on this. The first one is, when you bought insurance policies, and you personally have bought insurance for both business and personal reasons in the past, did they hand you a blank check?
No.
So they never gave you a check to use? Okay.
No.
I want you and your listeners to keep that in mind. See, the reason that we're not afraid of you doing bad, not that Jen J. Hammond ever would, but that we're not afraid of anyone doing bad, is because we don't hand you a blank check. At time of loss, you have to go through the scrutiny of what happened before we release your claims check. And so because of that, it doesn't really matter what you told us when you closed. It matters what we find out when you claim. And a lot of people think insurance companies are bad for that. I got to be honest, I don't. This is a contract. You agreed to stipulations. You agreed to eligibility criteria. And you thought it wasn't a big deal that you were going to buy a home to purposely short-term rent it and then, tell us long-term. To the carrier, this was a massive reason. Remember, I told you that you might have dropped your carrier pool from 20 to 2 in that one little question. So you can't be upset now when your carrier comes back and says, hey, this claim is in direct conflict of, we would have never wrote your business had we known. And now that you have $100,000 loss, tell you what, we're even going to give you your money back, because they'll do that. They'll say, here's your $4,000 back. We void that this policy ever existed.
Wow. There you go.
Now, again, could you sue? Could you end up in court? But to your point, if I'm an investor, my goal is to make money, not
Yeah,
spend it. I don't
right.
want and again, I'm in the risk management business for a living. I don't just peddle policies. For my investor clients, what I share with them is, could you get away with it? Maybe, because that'll lead to the second point I told you I was going to make down the
Yep.
skunk road.
Number two. Yeah. What's the next mistake?
How bad of a claim is it? We have a
Ah,
minor claim. Maybe they pay it and just cancel you. Maybe
yeah.
they pay it, they don't pay attention. But if you have a major claim, and a major claim by my definition is one that would have cost you more money had you have handled it yourself. A catastrophic loss by definition really has nothing to do with how much money it costs to fix it. It's how bad it would be for you if you had to pay for it yourself. So as an investor buying homes, a catastrophic loss wouldn't necessarily mean the whole house burns down. A
Yeah.
$50,000 kitchen fire that I got to now pay myself because it happened during an Airbnb rental could take away my profit for the whole year. That
Yeah.
profit was supposed to be my vacation to Belize, right? And so that would be catastrophic. I would never want to risk my coverage at the most important times instead of just doing it correctly.
I agree. I agree. I think it's so important. And I say as a coach, but also as a licensed real estate agent, just don't lie. Let's just confront the numbers as they are. And let's not try to make them something they're not. If it's no profit as a real estate investor, there's no profit. Or if the margins are too slim, then that isn't the thing that you should be looking at. So okay, back to the biggest mistakes. We're talking about the three biggest mistakes that real estate investors can make when they're investing in property in Florida.
All right. So, and this gets very nuanced, and we could spend hours here, but you have to know your lane as a property investor with how insurance is going to affect you. Now, that's very 30,000 foot. Let me drill down on that a little bit. If I'm an investor and I'm using financing to get my deals done, understanding that the home has to pass inspections is a huge part of this. To your point,
Mhm.
and again, there's a million different types of investors out there. But if I'm the investor using financing, I've almost got to think like a home buyer, that this home has got to be able to pass inspections. It's got to be able to get through. Now, again, obviously there's traditional financing through lenders, and there's creative financing, and there's private financing. And I can tell you that I have over 6,000 clients, and a lot of those are rental properties, and some of them are financed by private placement, but the private placement still wants that home to be in a condition that it can get insurance. So you have to, if you're one of those investors that's using financing, make sure you know the rules of the game. Make sure you understand what your finance requires. And if they're going to want it to pass a traditional inspection, then you need to be able to read that inspection. You need to be able to look at a 4-point and win mitt. And what I always tell people is, think of that $250 in inspections as the most amazing due diligence cost ever. You're right. You're looking to buy a revenue stream here. So if it doesn't generate revenue, it's a bad deal. You said it a minute ago. Sometimes it just doesn't work. And so even if they offer you, one of my favorite sayings in insurance is, never let the smell of premium, right? Never the aroma of premium cover the stench of loss.
Mm.
Sometimes we look at a home and we say, my God, I can get this thing for 50 grand under market value. It's an amazing deal. But now if I'm going to have to spend 8,000 extra on insurance or 5,000 extra on insurance, it doesn't become a good deal. I just lost $600 a month in revenue. So understand who you are and how you buy. And then in the inverse of that, if I'm a cash buyer, understanding that, and again, if you have the right agent, though, you have to have a relationship where you're honest with your agent or they're honest back with you. I every week have conversations with investors who go, okay, Rich, this one's a pig. How am I going to get it done? And it's important that as an investor, you have an agent that has policies to cover the good ones, has policies to cover the bad ones, because I have very unique ways, and we don't have time, that we can get some pretty trashed homes through closings. And you have to make sure you have that in your quiver. You have to make sure that you've got that arrow so that you can shoot it when you need it. Because of course you want to get a great deal on a rental home. Of course, sometimes homes that have challenges make those best deals, but you still got to get the transaction to close. And to do that, You got to know what you're working with. So make sure you know what your finance requires, and make sure you have an agent that can give finance what they need. So that would be my second one for you.
So number one was the use. Be honest about what you're going to use it for, whether it's going to be for daily, weekly, whatever, or long-term rentals. Again, because the other thing is a lot of times people say, oh, I'm just going to use it as a second home. They use it as a second home, but then also as a rental. So again, whatever the use is. And then number two is, again, what the
Know
insurance.
Know how condition will affect your maneuverability through finance and close.
Perfect. And making sure, again, emphasizing passing that 4-point inspection. Okay, what's number three biggest mistake that real estate investors?
We got to talk flood insurance. One of the things that's misunderstood, especially if you have an investor that decides to buy here in Florida, flood insurance in other parts of the country, it's $500 a year. It's $400 a year. Flood insurance can be $25,000 a year in the state of Florida. It can be 800, 900. It can be under 1,000, but it can be $25,000 a year. And again, if I'm an investor, right? If I'm an investor, it's not even, I've got an automatic extra $400 I have to pay in Florida just because it's not a primary home. So my flood insurance automatically goes up. Now, $400 isn't a big deal, but that's a small example of how flood insurance can bite into that margin extremely quickly. Comes back to the finance conversation. Are you going to have to buy flood insurance to close? If I'm a cash investor, I'm less afraid of this because I can buy. If I'm a cash investor that's going to flip it, I'm even less afraid of it. Although that investor still needs to think about who they're selling to. If I'm a cash investor and I buy this home and I do all the work and I fix it up, and then everybody finds out it's going to be $20,000 a year to insure the flood, it's going to be a whole heck of a lot harder to sell that home because it's going to be a challenge or an obstacle to the buyer typically. And so again, there's different reasons our different investors need to worry about it, but you have to understand what flood looks like, what it costs, and then factor that into your equation when you're deciding to put homes that need flood insurance in the portfolio.
And so I'm going to take you down that dark road again on a worst case scenario, because often I hear someone say, oh, I'm just going to pay all cash so that I'm not going to need flood insurance. And then they've got like a waterfront home. And then they're doing, of course, what we'd say was the highest risk. They're doing a short-term daily kind of Airbnb rental. So they're doing all the highest risk. And then they just decide to just self-insure. They're just not going to do anything. Let's go down that dark path.
It's fun because about once a month at least, I get a wonderfully sweet, loving, awesome, cute senior that calls me and says, I just paid my mortgage off. By the way, fun little side note, the word mortgage is French for contract until death. So when they first started doing mortgages, it was meant to be forever. I always loved that in the back of my mind. But I get a little senior and they're 75 years old and they've lived in their home. It's this wonderful story. And they say to me the following words: I paid off my loan. I don't want to carry insurance anymore. And I have to respond with the following: even though your loan made you carry insurance, that's not why you carried insurance. You carried insurance because of the following question: can you afford to rebuild? Should it be completely decimated? Do you have the funds to do it? Do you have the funds? The official is to risk retain on that versus risk transfer, which is buying an insurance policy. Now, I'm sure you have some wildly successful investors who are willing to risk retain. And frankly, if they lose a $300,000 home and they roll those dice, I would tell them that I'd build it in as a cost of goods sold. I don't agree as an investor myself, and I own some properties. I pay that cost of insurance so that it would never, ever reduce my margin so drastically at a moment's notice. Second point to that, tidal surge is considered. So a lot of people think, well, my hurricane coverage is going to cover that. The inland surge of tidal water is explicitly defined as flood, not wind. So like in Hurricane Ian that we just suffered here in the west side of South Florida, all of that damage you saw done by surge, even if they had a homeowner's insurance with wind, it wasn't covered if the damage was tidal surge. So if the water, the 30-foot wave of water that knocked the home off the hinges did the damage, it's flood insurance that's responding to that right now, not homeowners insurance, which are completely separate here in Florida the majority of the time. So again, now we're back to that first question. I'm an investor. I want to make margin. Do you really want to take an extra $300 of margin? And again, I'm being arbitrary. You want to make $3,600 extra a year and risk a $300,000 loss? Just go look at any picture of Hurricane Katrina in Mississippi, Biloxi, or just go look at Ian. You don't have to go back but a couple of weeks to see how much damage can be done. If you're gonna buy on coastal, you really need to factor that into your margins. And again, that's just, it's one man's opinion, but because again, not from nothing else, it's about, as investors, we're all focused on the profitability. There's nothing profitable about saving $3,000 for 5 years in a row and then losing 300,000. So that would be to answer your question.
And I take it to that dark place also because I've seen the devastation firsthand from numerous. I grew up in the Florida Keys, and I've seen a lot, and I lived down in the Caribbean for a while as well. So I have firsthand seen the damage that a storm can do. And again, the devastation from so many people who, didn't have flood insurance, didn't have the right insurance, all of the above. And that's one of the reasons I wanted to make sure we went down that dark path. And when we talk about the mistakes, some of the biggest mistakes, and I know we could talk for hours, but we're out of time again. So I want to make sure that if real estate investors, if they want to contact you and ask you questions, I know that you would take their calls as they're looking at properties down here, but also would you share your Facebook, your website, phone number, anything so they can get in contact with you?
Sure. And again, just to put it, my name is Rich Ficca. I'm the owner of Florida Coastal Insurance Agency, and our website is that simple. It's long but easy. www.floridacoastalinsuranceenagency.com. Our Facebook page is the same, and our agency, we write statewide throughout the state of Florida. We write all the way down in Monroe County in the Keys, all the way up up into the Panhandle. And so our phone number is 727-569-6000. When they call, they'll get a prompt system. Any of my team is happy to answer any questions they have as investors and help them through this process. And I personally love to take those calls as well. I'm an extension 101. And so I hope that helps.
So I want to one last question before we end off, and that was that I wanted to say also, as real estate investors, they also own multiple LLCs, and you insure businesses as well, correct?
Yeah, actually, truth be told, I have an amazing team that does the heavy lifting on writing policies, on dwelling property policies for investors or homeowners for homeowners. I spend the majority of my day consulting my commercial clients, which many of them work in multi-single family. So I have clients with 40, 50, 100 rentals. Some of those clients are focused on Airbnbs. Some are I have many that are flip, guys and gals. So no matter which way you're taking it, I do quite a bit of insurance for multi-unit residential, whether it be apartment complexes, condos, etc. So whichever way they're kind of doing, we've done quite a bit of it. 26
Excellent.
Years, I've kind of seen it all.
And that's why I know that your head's right over the business word in there. So Florida Coastal Insurance, auto, home, flood, and business. So if you're looking for any of those insurance, I highly recommend that you reach out to Rich at Florida Coastal Insurance Agency. And as you know, I'm always looking for the silver lining. And so I'm going to ask you to raise your voice and say yay with me as we go off the air. Is that okay?
Sounds great.
Okay, 3, 2, 1. Yay! Perfect. Thank you, Rich.
Hi, I'm Jack Canfield. You may know me as the co-author of the Chicken Soup for the Soul series. And if you want more help in getting from where you are